Welcome everyone to Options with Hans. I'm Hans Albrecht, your friendly neighborhood options trader. 15 years as a professional options market maker, another decade managing a dozen cover call and income type funds, downside protect funds, as well $1 billion in strategies managed, Ivy League masters, regular on TV, quoted, published all over, hundreds of articles, an all-star of options trader, presenting alongside legends like Tom Sosnoff. So why am I here? Simple, to help you do this better and with substance. If you want cookie cutter option stuff, there are tons of experts out there on YouTube that I liken to a doctor that only plays one on TV. You get what you get. I've got a movement going here to teach you how to trade and invest with options like a pro, sensibly and thoughtfully. Tens of millions in profits. Grab my free ebooks down below, and if you sign up before tomorrow night, I'm also going to give you my 3-part intro to options course absolutely free. As always, this is for educational purposes only. Your trade, your responsibility. Now, today's matchup is Amazon versus Walmart, but I really want to focus on Amazon. And these two companies are sometimes put in the same kind of bucket, two giants, but only one, in my opinion, is really positioned for this AI-driven future that we're facing. And it's actually not even close here. Many of the same consumers from a discretionary spending standpoint in those companies, but a very different future when you dig a little bit deeper. One's kind of neutral to almost defensive in terms of a retail play. The other one is really that plus an AI infrastructure stock hiding in plain sight. And incredibly, Amazon's cheap. It trades at a lower P than Walmart. AWS, which is their cloud service, is set to explode with this new AI inference demand, just early innings and starting to soar. And not only that, Amazon owns a stake in Anthropic. They've had this robotics lead since the early 2010s. We'll talk about Kiva. Don't be surprised if they make that a focus at some point, as AI at the edge, meaning AI in every device, in every sensor, in everything around us, is infused with intelligence-based utility, usefulness. So let's break down why Amazon isn't just the better AI story, it's the better value and quite possibly the greatest combination of a real world combined with digital world exposure out there for investors right now at a fairly reasonable price. And I'm going to show you the trade setup that I'm going to use at the end, so stay tuned. We're killing it on Amazon positions in our Leaps Trader program, but this AI phase is early innings. There's plenty of opportunity ahead for us, and we're going to be putting on more trades this week. So here's our game plan. We're going to look at the valuation snapshot. We're going to look at cloud and AI inference because we got to talk about the big thing that's going on out there. We're going to talk about Anthropic, this kind of nice sort of almost hidden value that just keeps increasing and feeds into what Amazon actually does. We're going to talk about the robotics moat a little bit and then the trade. This is how I play Amazon over Walmart. So let's start with valuation. So Amazon is trading at a 36 PE, basically, a PEG ratio of about 2 to 2.8. So let's look at Walmart here. We've got PE 38, we've got price to sales ratio 116, and a PEG ratio of 4.56. Typically, something closer to a 1 is going to make a little bit more sense because PE is one thing, right? So the opportunity, the way that a company is executing is one thing, but when you relate it to actual growth, then we start to see things in a different light. Some companies, we can't really do this. If they don't have earnings, we sort of look at other things, price to sales, things like that, net revenue retention, things like that become very, very important, like an Palantir or Snow. So let's look at Amazon now. PE of 35, lower than Walmart. Forward PE 33.53. Let's take a look here versus 36.55 for Walmart. And a PEG ratio of 1.91 versus 4.56. Wonderful, wonderful. So despite this kind of faster secular growth, Amazon is actually a cheaper stock by P, by PEG. That's kind of rare. Usually a company with a cloud business and AI hooks is kind of an expensive one, but not here. You're paying more for Walmart groceries than Amazon's cloud rocket ship that is really just about to rocket even more quickly at a kind of non-linear rate. So on the e-commerce side of things, they can sell just about anything. So every time Amazon says it's getting into some new line of business, other companies shudder. There's a good reason for that. They have incredible buying power, but Walmart does as well. But Amazon is the king. These other companies are just prey to Amazon, waiting for the moment that Amazon says we're going to get into your business. Let's take a look at Q1 revenue. accelerating 29.3 billion, up 17% year over year. That's not retail growth. That's hyperscale compute type growth that we're seeing. We know that e-commerce has never been a massive needle mover for them. It's the other stuff that allows them to take over the e-commerce world, but it's that other stuff that is going to continue to be the focus in this phase. AI inference demand. Training big models is a one-off event, right? That's a one-off event, maybe a few times event, but inference, every chatbot reply, every recommendation, every robot vision scan, these things are going to be running 24/7. As I always say in my videos, the gears continually turn. They do not stop turning. They do not stop to sleep. They do not stop to eat. They do not take days off to be sick. Compute hours are going to be increasing exponentially. Data is going to be increasing exponentially. It is going to be like electricity. It's not really GDP cyclically kind of dependent. This build out is happening. It's as simple as that. If companies need to find money to get on board, they will. They will cut costs in other places because this is about something that is very exponential, very existential at this point, as well as exponential. So, and Amazon's got they've got their own, they rent servers, which is absolutely key. They've built these Inferentia training chips, Trainium chips, purpose built for AI workloads, right? So they're not just about storing your furniture in the back of a closet, in the back of a storage unit. This is becoming more and more the inference phase. They realize that that's very important. Smart storage is an absolute key. So this is going to be, think of Amazon as a default highway for inference, a default highway for inference, AI startup reliance, plumbing behind AI. That's why when it sold off after Microsoft, after Google, their cloud numbers were very good. This thing sold off hard. And I posted in the community everywhere. I said, this is ridiculous. These guys are absolutely in the right place at the right time. Yeah, they don't have that cloud-based system that is very ecosystem connected, right? Like an Amazon, like a Microsoft does, or a Google. Those are ecosystems that are really driving some of that cloud growth because they have actual embedded ecosystems that people are a part of, and those just make those systems better. So those are terrific models. Amazon is more of we appeal to everything else out there in the world, and that is a world that is just growing and growing and growing. Now, Anthropic and the robotics moats. Okay, so Anthropic just raised money at 183 billion valuation. We know that ChatGPT has been valued at around $500 billion, give or take. We know these models, the good ones, are going to be worth more and more, trillions probably, because they are going to be the backbone behind many tools that are going to be created and that are actually going to threaten existing businesses. What's the great thing? Well, unlike Microsoft, where the relationship is a little bit murky with ChatGPT, is it revenue, is it equity, it's a little bit of both, Amazon owns around 17% of Anthropic. So that's a $30 billion stake on paper. And it locks Anthropic into their AWS, into their cloud system, right? The Anthropic's models run on Amazon Cloud. This is not just an investment for Amazon. It's kind of a customer flywheel that continues to work for them. And as it continues to work better and better for everybody else, the value rises and they benefit from that. Now, robotics is a little thing, right? They produce robotics. They have 1 million robots in warehouses right now. They bought Kiva all those years ago, and they completely revolutionized the way that warehousing was done. Nobody could even measure up to them for years and years and years. That's one of the great things that Amazon did, is they created that fulfillment, that process of when we order something, how does it get to our doorstep so quickly? That is an incredibly strong and powerful fulfillment process that they've developed in part with robotics and automation, those little robots that zoom around the warehouses. They continue to do that. At some point, they are going to have the ability, they don't do it right now, they don't sell commercially, but at some point, they are going to have the knowledge and ability to create these kinds of things. It'll be very interesting to see. That is kind of a hidden potential value. Basically, Amazon builds the robots that they use. Walmart couldn't even buy that same level of automation for less than an absolute fortune. Amazon is so far ahead of everybody else in that area. Let's talk about some of the option pricing, some of the interesting things that I'm seeing there, and some ideas, and of course, a trade. Okay, so before we do that, let's look at some broader risk measures so we can see the VIX futures curve in a very nice contango. So this is a picture of health. It's quite steep. It's as steep as, lately we've seen it as steep as we've seen it in years. So what that means is there's an exceptional amount of calm and really optimism, even though this is kind of, in a way, one of the most hated rallies we've ever seen in terms of people not being in. There really is a certain amount of extreme calm we're seeing across asset classes. We're seeing vol numbers come in, the MOVE index. We're seeing many areas that are basically pointing to a lack of concern out there, despite fiscal irresponsibility, et cetera, what you might want, those things that you might want to point to, dollar weakness, et cetera, foreigners maybe selling things. Although I said about 4 months ago, I said, listen, foreign buyers selling assets are going to be absolutely wrong. This idea of U.S. exceptionalism ending is absolutely ridiculous, I said. And sure enough, we've seen that foreign money basically start piling back into the market ever since May. It was a 1 month event. I said they're going to be wrong. The U.S. leads in all the important categories of technology. It's got the best consumers. It's got the best pretty much everything. So it is what you want to invest in when you want to invest in growth and risk and leverage and a population that just absolutely loves to spend money. There's just nothing to compare to that in the world. So anyway, there are people pushing back in. Systematic strategies are probably topped up for now. So that tailwind is probably a little bit thinned out at this point. But really, we have this AI thing that I think is just going to continue to keep this market bid for now. Just, barring any kind of yen carry trade problem again. We'll have to see what happens, but you can see that what we're seeing is a very steep skew out there. Now, what that means is people are really buying a lot of protection. And when people buy a lot of protection, some people think that's bearish, right? They're saying, "Oh my goodness, look, it's downside put skew is at multi-year highs. My goodness, everyone's getting super bearish. Maybe I should get bearish too." That can be really misconstrued as bearishness. A lot of the time, it's just long with protection, right? You own your house, you have house insurance, and you can stay long your house. You can own your house with a peace of mind that you have some insurance. It's the same kind of thing. There are many entities, institutions, pensions, many mandates out there that have to own downside insurance. And if they have to pay up for it, well, they have to pay up for it. It happens to be expensive right now. It does not mean they're bearish. It means they are actually it's quite supportive of markets, because when people are insured, adequately insured, then they don't panic to the downside as much. What we saw last year is that people did not own protection last August 2024. They didn't own enough protection, and so that helped to exacerbate the panic to the downside because they needed to finally buy some protection. So there's a certain amount of evidence that really people had kind of thrown the idea of protection and hedging aside, and that's part of what got the VIX as high as it got to, and et cetera. So this is really a scenario where I wouldn't read too much into very, very expensive protection. I think it emboldens people to basically stay long, stay the course. One of the things I like to look at is when we get my VIX 9-day, 30-day down to about 0.75, that's when things get a little bit quiet. And sure enough, again, we can kind of see that we have trouble getting even below that, right? That's in a sense, that is kind of what we're looking at in the VIX futures curve a little bit, that there's just maybe a little bit too much calm. There's a little bit too much low vol in the very, very short-term measures versus the longer one. When the longer one, the VIX does not want to drop anymore, but short-term measures keep dropping. Eventually you have a big gap, and it's just, at least it's a reason to have a day or two or a week sell-off. We're just not getting a 1 week sell-off anymore, right? We get 1 day down, we get 2 days down. That's the absolute max because of this underpinning of all the positives that could come from AI and lower rates that are going to help a lot of companies. A big part of the population works for small and medium companies, right? So if you now certainly we have people getting let go from technology and a few other areas. That is probably going to be a problem over time with AI in general. But in the meantime, you're going to really kind of give a big boost to a lot of the small caps, which is why they've been acting quite well lately. So let's take a look at some of the option pricing here. We can see that, let's take a look at something a little bit sort of shorter term, we can look at 2 month vol. Really not very high. I mean, it's you've got this rank and percentile very, very low. So there's no question that we've bounced a little bit here, but we're extremely low from the perspective of where has option pricing been in Amazon. It's very low. They're starting to get a little bit more excited about things, which is, I said a month ago, I said a lot of these longer term vols are very, very cheap. So if I look at some of these out of the money calls, you can see very clearly that when I started sounding the benefit to that about a month ago, these things were low, and I don't think they're expensive. Even at this point, this is not a market, not an options market that's really pricing in more melt up. So we've got, and really this is barely a move, right? 28.67 to 29.60, like it's nothing. So this is a little bit of a bounce back, but overall these are still very, very cheap. I think the skew is not expensive. As I've been saying, you can win many ways when you get the right kinds of options, which we focus on in Leaps Trader, which is, if you get the right ones, you get a number of Greeks working for you. You get that delta, which is your directional bias. You get that vega, which is the fact that vol's too short, too low rather, and it could boost. And then you get that skew, right? If the skew's too flat to the upside on calls, well, you can get that normalization of skew, which is going to push them up as well, right? So you get a lot of ways to kind of have that position work out for you if we do ultimately get this melt up, which I think will happen. So I think things are still pricing, even though they've come up a little bit from when I started talking about this. I think they're still very much in the driver's seat. So something I would look at, if I go into Amazon options, I would look at probably something. You could look at June of next year. That's not quite a leap. A leap is technically 12 months, but you're kind of splitting hairs, 10 months, 12 months, who cares? But you probably, if you want to sort of play it safe and just have that low theta and really not a lot of vega risk, which is that risk of volatility coming down. As I mentioned, when you get in at low levels, you don't have that vega risk, right? So that's yet another nice benefit to those low vols, is that there's a tiny little bit of room for them to drop, but I'd say the upside is quite a bit bigger than the downside in terms of that option pricing. So you could get in, pick up some 200s of September of next year, 2026. Pick those up. One contract's going to cost you about $5,300. That's going to be a little bit more of a stock replacement type strategy. You're going to feel a little bit better about that replicating the ownership of 100 shares of Amazon, which is going to cost you over 4 times as much. So this is a nice way to kind of create that upside without kind of having to spend as much. And then if you have cash on the side, then if you do get a sell-off, now you've got some ammunition, you've got some dry powder. Or you could go a little bit more to the upside, playing for that explosion type trade, which is going to be 275s, maybe for about $1,500, 15 or to $1,600. You pick up one of these, gets you kind of a little bit more leverage. If you were to spend the same amount on each, you're going to get a little bit more leverage out of that with multiple contracts, right? Or you can just keep it to the one contract, which is not going to be too expensive, but it's going to give you that nice convexity, which we call, option traders call it the convexity, that ability to really kind of have that explosive move that's going to tack on a very nice potential return on this, right? So by September of next year, I mean, I could see Amazon 320, 325, something like this could be worth, $40, $50, $60, depending on how fast it gets there. And that's a real nice potential return, right? 400, 500, 600% potentially on something like that, because as I said, these guys are just in all the right places. Is it going to depend on overall market? Yeah, absolutely. So if the market has some reason to kind of crater, then everything's going to get hit. Good stories, bad stories, everything gets hit. It says but if you're in markets, you're willing to take some risk. And when I sort of add up all my layers of potential edge in this trade, I get excited. We're already in there. In Leaps Trader, we're already making tons of money on positions in this, but I'm going to be adding to more of this because we have new members all the time and they want to know, what are your favorite things? This is one of my favorite things, okay? I'm not going to lie to you. This is one of my favorite things. And then you can actually, over time, you can start adding hedges that really give you that upside convexity, plus the ability to play a sudden unknown that just comes along and sideswipes the market, and you're not gonna get too smoked if you have those correct hedges, which we have in some positions already. So I hope you guys got something out of that. Not financial advice. As always, I cannot speak to every situation. Everyone is in a completely different demographic, age, goals, et cetera, et cetera. That is all up to you, your trade, your responsibility. But these are some of the ways that I think of things. It gets a little bit more complex than that in the program, but I hope I've given you some sort of framework and guidelines as to how I approach these sorts of opportunities. So don't forget, sign up for those ebooks. If you're still watching, sign up for those ebooks and you'll get that 3-day course for free, and you'll get into my flow of communication. I don't overdo it. In fact, I need to be reaching out even more, and I don't. So I'm going to get a little bit more intent on increasing the value that I push out through newsletters and things like that, because I know that everyone's looking for that extra little bit of info, something other than sell puts on a red day. You know, that's the basic plain vanilla stuff that you're going to get from most places. So hope you enjoyed that. We shall see you in the next video.